Hola guys, and que paso? What's going on? This is Hala Pablo. Welcome to another cryptocurrency analysis video. We're still looking at Bitcoin. Let's get right into it. Yesterday we looked at a couple Wyckoff schematics that I had on for the distributional bias of Bitcoin on the 1 hour. And today I want to expand out. I want to zoom out a little bit on the 4 hour and kind of tie things together with some of these rising wedges that I've located in the macro. So going from say this is back in June of this year all the way to the current. What's today? The 9th of December. So this encapsulates that time between those months. I don't know, what is that, 4, 5, 6 months? So you see that the price action of Bitcoin is linked together more or less by a series of rising wedges. Rising wedges. What are rising wedges? Rising wedges are very reliable bearish continuation patterns, okay? Especially when they're coming out of a bear trend like we see here. We've been in a bear trend, haven't we? I don't think that's debatable. We are in a bear winter, so everything has been a bear trend. We've had counter trends, but by and large on the macro scheme it's been decidedly bearish, obviously. So look at all these distribution points, these markdowns that come from rising wedge to rising wedge. What are rising wedges? Rising wedges are essentially, they're just crooked tops. That's the easiest way to explain it. Let's just keep it simple. Rising wedges are essentially crooked tops. There's a series of rising highs and rising lows, although they're not exactly parallel to each other. If they were parallel, then it would be a channel, or if they were horizontal, then it would be a trading range. But these are trend lines, and trend lines are rarely run parallel to each other, especially when it's coming out of a bear trend. So on the support and resistance of these lines, we have the lower portion is considered what? Oversold, 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 and the top lines, the overbought. So if you know how to use these with price action, then this pretty much replaces the RSI indicator. You don't really need the RSI indicator. Not to knock anyone who uses it, but I find trend line support resistance overbought oversold points to be much more reliable in keeping in the context of where we are. So if we go off this, then you have a pretty good idea of what to expect on these intra wedge bounces stuff. And of course at the end of the wedge, as the price action meanders towards the confluence of the trend lines, we can almost always count on a distribution. Sometimes before the distribution they'll mark up a little bit and fake out just to grab liquidity before they dump. You don't really see that on this 4 hour. This is pretty clean, these distributional cycles. But one thing's in common, there are so many wedges, rising wedges or ascending wedges here. They definitely predominate. They're the predominant geometric pattern or shape. There are a couple symmetrical bear triangles here, but by and large we're looking at wedges in this particular range, this 6-month range here on the macro. And if you zoom in into these wedges, we can on the micro, we can find series of Elliott waves, obviously, and the Wyckoff schematics, which, like yesterday, we did a distributional on the 1 hour on the micro. And so when you identify these patterns on the micro, go ahead and zoom out and get the full big picture and see if it confirms the bias that you had on the micro. Usually the micros will confirm the macro. So let's look at these here, and These patterns here, what I want to do, because they're pretty much self-explanatory. If you want to learn how to trade rising wedges, I recommend just looking them up. I'm sure there's plenty of tutorials on YouTube and elsewhere, and also in TradingView to look at. But here, notice that every time the price action reaches the confluence or the end, let's go ahead and make this yellow, the confluence or end of these patterns where it's about to distribute, it's a good idea to go down and look at the volume and see what the volume is doing. And that's how we tie in volume reads, volume price action reads with price action, which is in essence VSA. VSA is a derivative of Wyckoff. It's basically Wyckoff simplified. We look and see, like for example here, when this price broke down, we had predominance of supply. Again, predominance of supply out of that one. Again here, supply expansion. Usually we get an idea, especially in like rising wedges, it's a good idea to go back and back test all these wedges. Pick your favorite coin, XRP, XLM, Solana, AVAX, whatever. Go back and look and find these rising wedges, find patterns like that that you know are bearish, and then do a volume analysis inside the pattern, and you almost invariably what you'll find is predominance of supply. So that is supply building on the pullbacks and demand shrinking on the upthrust. If things were going to accumulate, usually you see the opposite. You see confirmation between volume and price in the upthrusts, and then you see diminishment of supply on the pullbacks. With the rising wedges, it's different. It's the opposite, which gives it its bearish bias. So you can go and just do. It's a good exercise to do. It trains your eyes in pattern recognition, and so yeah, you see supply building in almost all of these areas. Here's another building of supply. See, supply is building, supply is building. Look at in contrast. Look at demand now. What's demand doing in these? Demand is almost always shrinking. Demand's going down. It starts off with a spike and then it just decreases from there. And that's usually on the upthrusts, on these waves, on these zigzags. So here, here it's going down. Here it's kind of like equal. They have equilibrium here. Here's kind of going up, but it's low. When demand goes up and expands inside of a pattern, usually it's on low or moderate volume, in contrast to supply, which is usually always expanding and has the same magnitude or larger. So that's one of the ways you could tell. So okay, so what I'm going to do now, I'm going to remove all of these trend lines here, and we're going to go and focus back to what we were looking at yesterday. Here's where we are right now on the 4-hour. This here is the Wyckoff, what I termed the Wyckoff distribution range, what I believe is going to be a distribution from yesterday. So we already know that we're in a rising wedge. We've already identified that. So already our bias is already decidedly bearish, or mine is at least. Here's your higher highs, and here are your higher lows. We see the wedge narrowing as it advances, presupposing that at some point the price action is going to get squeezed. And when it gets squeezed to the end, to the confluence or the apex, presumably it will distribute. So that is another reason why I am distributional on this Wyckoff schematic here, even though it's on a it's smaller, it's on a 1-hour. Well, the one we were looking at yesterday is on a 1-hour. If you look at it in the grand scope of things, it fits. It confirms the bearish bias. Now, this does not mean that we are going to completely dump from here at the end of this when it breaks free from this wedge. If it does distribute, we could go, there are different support lines throughout this structure. Well, I call them liquidity voids. You think of price action like water. Water seeks its own, so whether up or down. Here we see this liquidity void mitigated. This is the selling climax here, and it mitigated it with this, this is the automatic rally, and then it came back down for the secondary test. Let's go here, yeah, automatic rally, and then we'll call this a secondary test here. And then it came down here. This is a sign of weakness. I wouldn't exactly call this a spring. Some people think it's a spring. I don't think it is, because it did not go beyond the secondary, rather the selling climax. It didn't penetrate this level and go down further to entice people to sell, to those who are holding here, to sell at a loss and then come back up. Like, that's what springs are for. So it did not go further. It did not break this selling climax sell order block here. It came back to it. It simply mitigated it. So and then this was the beginning of the wedge, of the rising wedge going up. And so we could go down and triple mitigate this. Once we break out of the rising wedge, we could triple mitigate it. It'd be a triple bottom. That wouldn't, you know, almost all of the wedges that we saw on the macro when I pulled it out and I had all the trend lines drawn out, all of those had mitigated, at least double mitigations, triple mitigations on some of them on the bottoms before they redistributed. But the point is that this does not have to go and just dump wholesale and just go, you know, intergalactic, like we talked about, and form a whole new redistribution range. Although I believe this is a redistribution range, there are levels of pullback, of support pullback, of support retracement that we could hit before we completely bottom out down here. And the same thing with going up. Remember, we have order blocks up here as well at the automatic rally. This is a large order block, and then a very, very big one would be this one here at the what would this be? This would be the PS in Wyckoff terms. This would be the primary support. So this is where the first signs of demand come in during a dump. So you got a pullback or a dump or a markdown, and it's in a free fall. The first signs of demand coming in, slowing it down, putting on the brakes is called the preliminary or the primary support that comes in contrast to supply, which would be coming out of an upthrust or a markup. We would have the PSY. So sometimes it's confusing. You get those two confused. PS comes out of a bear trend. So, but the point is that this would be the upper liquidity void, the macro void, that the price were to suddenly just rally out of this wedge and just do an anomaly, which Bitcoin has been known to do. Bitcoin doesn't always do what you think it's going to do. It likes to buck the trend and catch you by surprise, and it could very well shoot up here and mitigate this PS range. And if it does that, then we need to be very careful, because this is a big supply zone up here. This is one that they're guarding. If we basically bust through this, then then the moon boys, the Bitcoin max, you know, the maxis and the moon boys have cause to start jumping around and partying, because that's, you know, that would be a decisive victory for the bulls. But right now, I don't see that kind of volume coming in, at least not in this range, to kind of hearken something like that, a kind of an event, a lunar event. That would be a real lunar event if it busts through that. I don't see lunar demand in here. I see supply reemerging now as we grow closer and closer to the confluence of this wedge. So anyway, I'm still biased on it, but that does not mean that we can't have a series of bull traps before we mark it down. If we do mark it down, eventually we will. According to the Fibonacci retracements, I'm just going to go off the selling climax, and I'm not even going to go off the AR all the way up here, wick. I'm just going to go off this UT triple mitigation point, and that brings the 1.618, which is the golden retracement level, to $14,300 Bitcoin. Of course, the one Fibonacci would be the triple mitigation area here. That, remember, that ties into the SOW and the SC. So that would be the triple mitigation point, and then the 1.272. Now we're down in the 14.9s. We'd already surpassed the previous low. And then the 2 Fibonacci is the 13.6, and that's how you hear these traders talking about $13,500 Bitcoin. They're talking about drawing the retracements off of a pattern or a redistribution range like this, going off the highs and the lows. If we drew the high off of the wick up here that goes all the way up to the PS, remember the PS rally point, then that would make the 1.6 Fibonacci around $13,500 Bitcoin, which would be the golden Fibonacci ratio. So something like that is completely feasible, and we just need to keep watching it, and we got to hope for the best and be prepared. All right, guys, this kind of went on a little bit. I need to go. Hope you got something out of this, and like it, subscribe if this is something that you like. If it's not, then that's fine too. But if you're into just pure price action and no nonsense technical analysis, then this is the channel for you. I'd appreciate it if you give me a shout out if you like it, and yeah, let me know if you don't like it either. I guess I don't care. All right, guys, like, subscribe, and I'll be back with more updates soon. Thank you very much, and you guys have a great day. All right, bye bye. Adios. Adios, muchachos.